Good afternoon, everyone. Thank you for joining us for the Roundtable Union Budget 2021 Prospects for the Indian Economy, jointly organized by the Institute of South Asian Studies at National University of Singapore and the Singapore Indian Chamber of Commerce and Industry. If you have any questions or feedback to share, please forward them through the Zoom chat. The questions will be consolidated for the panelists to answer. This afternoon, we are delighted to have with us Mr. Vinod Rai, Distinguished Visiting Research Fellow at ISAS and former Comptroller and Auditor General, India. Ms. Priyanka Kishore, Head of India and Southeast Asia, Macro and Investor Services, Oxford Economics. Dr. Ajit Ranade, President and Chief Economist, Aditya Birla Group. Mr. Manish Tripathi, Vice Chairman, Singapore Indian Chamber of Commerce and Industry, and Group Chief Executive Officer, SAVAC Limited. Mr. Vikram Khanna, Associate Editor, The Straits Times, Singapore. Mr. Shubhamoy Bhattacharya, Consulting Editor, Business Standard, India. And Dr. Rajan Govil, Senior Economist, Singapore Training Institute, IMF. The roundtable will be moderated by Dr. Amitendra Palit, Senior Research Fellow and Research Lead, Trade and Economics at ISAS. I now invite Dr. Palit to moderate the discussion. Dr. Palit, please.
Thank you, Ramita, and a very warm welcome to every attendee, and a very special thanks and welcome to our very distinguished panel of speakers. Today's event is a joint event between the Institute of South Asian Studies at the National University of Singapore and the Singapore India Chamber of Commerce and Industry. And on behalf of ISAS-SICCI, it's a wonderful time for all of us here based in Singapore to look and reflect on the India budget that was presented on the 1st of February by the Indian Finance Minister, Nirmala Sitharaman. This budget has in a number of ways been termed a historic budget. There was very high expectation and conversation around the budget well before it was presented. I think there are many elements of the budget that would be worthy of extensive and detailed discussions as we distill and dive deep into the budget. But what I would like to share in the beginning is a particular thought on the India budget in specifics. Like India, which is a big and complicated country, the Indian budget is a humongous document. It's large, it's comprehensive, it's full of numbers. And when one looks at the Indian budget, people look at units like the lakh crore being repeated over and over again. And for those of you who are not familiar with the lakh crore, it simply means a trillion. And it's very difficult to take count of how many times this lakh crore actually comes out in the Indian budget and in what context and shape. So this overdose of numbers has a logic behind it. And that logic is the policy or the policy strategy or the policy direction that guides the allocations. Now, what we try to do today in terms of the discussion that we have with a very eminent group of speakers from Singapore and from India with us today is to find out this connection between the policies and the numbers. What exactly are the policies that have guided the strategy of the budget, the motivation of the budget, and what do these allocations mean? Were they purposeful? Did they live up to the expectations? Have they fallen short of expectations? And what does all these mean for India as a country looking ahead in the future? So with these few words, let me first begin by inviting Dr. Rajan Govil. And Dr. Govil, I think the best thing that we can do when we ask you to come on board and reflect on the subject that we have today is to start with what the world is looking like. I mean, you're with the International Monetary Fund, what the world is looking like, what the region is looking like. And in the context of both these two, what India is looking like. Over to you, Dr. Govind.
Thank you very much, Amitendu, and many thanks for inviting me to be on this panel of several distinguished people. I think from the IMF's perspective, things are looking up compared to what the situation was in October, for example. The vaccine has been developed and in many countries is being delivered, and actually people are getting it. So that's certainly a positive development. And in general, economies have done better, at least in some parts of the world. High frequency indicators are more on the positive side than was anticipated earlier last year in October. So consequently, what the IMF has done is that the IMF has upgraded its growth numbers for both 2020, the year that just went by, and 2021. And so things are looking better than what they were. So in 2020, we actually raised our growth estimate by 0.9%. When I say raised, that means we were looking at a decrease of about 4.5%, and now we're looking at a decrease of only about 3.5%. But more importantly, the growth in 2021 is expected to rebound to about 5.5%, slightly higher than what we'd anticipated earlier. And this growth is expected to continue into 2022. So from that perspective, things are looking better than what they were. But do note that there are several risks to all of these estimates. In fact, the IMF notes that, of course, this is a baseline scenario of 5.5% growth, but there's both an upside risk and a downside risk. Of course, if things start improving more, if the vaccines people get vaccines much quicker, or societies generally, develop some sort of a herd immunity, then things could be on the upside, and then we'd be looking at potentially world growth being higher, almost 1%. On the other hand, if things don't pick up as what we are estimating, then the growth may be lower at 4.5%. That's the broad global scenario in terms of growth numbers. And it's a similar scenario for Asia. But in Asia, what we've done specifically for India, because this is an audience probably focused more on India, is we were looking at growth in the region of about 8.5% for this year for India, and we've upgraded that to 11.5% in the January update. So clearly, that's more positive in terms of growth for India. And to a lesser extent, Asia is recovering, but again, it's a multi-speed recovery. China is doing better than what was anticipated initially. It's still looking at about 8% growth this year. Indonesia, Thailand, and some of the other countries are also expected to do better. But again, it's a question of what happens to the global economy as well, because some of these countries, like for example Thailand, depends a lot on foreign tourist arrivals. Whether they will happen or not is a key question. And of course, so there are multiple aspects, and I won't take up too much time, but I want to just talk about a few things from a global perspective, which are going to be a challenge over the next few years. Firstly, potential growth has been impacted. Clearly, global growth or global GDP levels will be close in 2020, 21, late 21 to 22, close to what we had before COVID. So, we lost that. But investments have not taken place. And that, apart from other aspects, means that potential growth going forward could be much lower. We've got countries with high debt levels and even higher debt levels now that GDP has gone down and countries are spending much more, which brings into question the issue of fiscal sustainability. There are going to be many people who are going to be slipping back into poverty. We are estimating about 90 million. And the other thing is in both the corporate sector and the financial sector. So we've got moratoriums and so on, which is potentially hiding fragility both in the corporate sector and therefore in the banking and financial sector. So those are issues that we need to keep in mind. Again, just to summarize, we're looking at things being better than what we had anticipated in October, but there are risks going forward. This is our baseline scenario, and then we have to see what happens. Thanks, Amit. Over to you.
Thank you, Rajan. That's a very nice beginning, I could say, to this conversation, which I think will be an engrossing conversation. You alluded to a large number of points on which I think we will have a substantial appetite to engage and discuss on. But before I turn to Priyanka, 11.5%. Well, 11.5% is a number worth giving an arm for, if not half a leg for. And you are looking very closely at India's macroeconomic performance, prospects, projections. So why don't you now come into the Indian macroeconomic prospects on the back of what Rajan has shared with us?
Sure. In fact, I think for once, IMF is more optimistic than the government. So lots to cheer about, at least on the face of it. Good start to the year. So I think one burning question with this budget has been that, is it growth oriented or not? Because there is a lot of headlines around the share of capital expenditure going up, but then there's also talk about fiscal consolidation happening, and in the context of the optimistic growth projections, this becomes very pertinent not only in the short run but also with the medium term, because the budget did talk about quite a relaxed fiscal consolidation path compared to what at least I was looking for. So I think I want to answer this question, which I have myself posed in terms of the budget growth oriented, not in 2-3 parts. First is to look at what fiscal deficit figures are we actually looking at. Now, the 9.5% deficit that is being projected for FY21, it is inflated by one-off accounting changes. One could also question the very conservative tax figures that are being talked about in the context of the first quarter of this year. So if we could just adjust just for the accounting changes, I would think the deficit comes down by around more than 1 percentage point. So you're then talking about a fiscal deficit of close to 8.1% or something like that for this fiscal year. And then moving on to the coming fiscal, once again, the consolidation is riding a lot on government asset sales, which historically have disappointed. So I personally have built in some fiscal slippage, and roughly then I would say that I'm looking at a fiscal consolidation of 1 percentage point between FY21 and FY22, which is much slower than what the headline deficit of 9.5 to 6.8 indicates. So yes, you are having a fiscal consolidation, but it is not sharp. It is also not coming on the back of compression in capital expenditure, which almost everyone agrees, and our own estimates at Oxford Economics shows, which have very high fiscal multipliers. And it should help crowd in private investment, which is already on a rebound. So that's the the growth oriented part of the budget. But if I put on my economist hat and talk from a fiscal impulse perspective, revenue expenditure has been cut back on, and I know some of the other panelists will be touching upon those aspects of it, so I will not dig too much into it. But the revenue multiplier is also high, above 1 in my estimate for India, and as that is cut back, the fiscal impulse is slated to wane. So from that angle, it's not an expansionary budget. The fiscal impulse will come off. It will come off slower than what we were probably earlier looking at, and it will come off in an environment where capital expenditure is still increasing, and that has positive spillover impact on private investment and the private sector. So that's how I view this budget. Now, if I take that into account, and also aspects of the revenue expenditure, because they have cut back in terms of rural and agriculture spending, which were boosted quite a bit last year. So you could see some reshuffling of growth drivers also happening in that context. A lot more allocation has gone towards urban development, etc. So we could see these sort of switches play out. That's from the near-term perspective. Over the medium term as well, they're talking about fiscal deficit still being at 4.5%, even by 2026. Now, that's, I think, is a very big surprise that has come from this budget, the substantial relaxation from the 3% FRBM target. And at this point, it is raising concerns or questions about fiscal sustainability and whether a rating downgrade is in offing, especially because we are on a negative watch, both from Moody's and Fitch. Now, I will not go too much into detail at this point. Probably questions will come up later, but I think a lot rides in terms of what kind of growth you generate in terms of this relaxed fiscal consolidation. If we are able to generate 6% plus average growth rate over this period, then I don't think debt sustainability is a concern. And that is something probably that the rating agencies will also watch out for. So at this point of time, we're probably in a watch and wait mode from that perspective.
Priyanka, thank you. I think what you draw our attention to is a very significant aspect of this entire economic scenario that is unfolding before us. In fact, and that in a sense makes a very important juncture in this debate on which I can sort of move on to Mr. Rai. I think the problem that is beginning to emerge, and that is a problem which is largely global, is that the COVID-19 and the associated conditions around it have pushed economies into counter-cyclical policies as almost a non-negotiable option. Economies have had to spend to support incomes, support lost jobs, and spend for getting the growth momentum back. But in that respect, economy like India has, of course, a number of challenges in the sense that there has been a large number of committed expenditure. You alluded to Capex, but you also alluded to the fact that fiscal slippages are very likely. So at some point, the question of receipts is going to loom large, and upon the ability of the government to actually manage the fiscal macro part of what it is looking at. And if on that context, sir, if I could come to you, Mr. Vinod Rai, who of course needs no introduction, but one of the things that I wanted to bring you on specifically, sir, is that for a very long time, whenever we look at the question of fiscal deficit in India and the fiscal targets, and from its very basic definition, the emphasis of the government in successive budgets has been on mobilization of what we typically call non-debt creating capital receipts. I mean, these are capital receipts which won't generate any kind of debt burden on the treasury. And those are what we typically refer to as the receipts or proceeds from disinvestment. That is selling off government equity in the companies and businesses that it holds. And this budget has been a landmark in this regard. This budget has been a watershed in terms of proposing one of the most comprehensive disinvestment strategies. I wanted to have your thoughts on that in your remarks, and also the fact that the disinvestment strategy is probably a part of the government's continuing emphasis on reforms, from which it doesn't appear to be showing an inclination to back out of. So it will be wonderful, sir, if you can take us through the disinvestment and the reforms content of the budget.
Thank you, Amitesh. Thank you for having me on the panel. The question that you asked, let's go back a couple of years. You remember NDA 2.0? That was a time when the government was coming up with this idea of a 5 trillion economy and things like that. It was a challenging task. That was a time when the economy was slowing down. There were lots of problems happening, but the roadmap was trying to be fixed in some kind of way. And they were trying to determine a very gradual glide path of reduction in the fiscal deficit. Now, the issues were the same: modernizing agriculture, increased pace of infrastructure, banking reforms, labor reforms, etc. All this was being planned when COVID hit us. And then, of course, 1 year is what we have had. Now, the good thing about this budget, before I get into what you asked me, is that it has tried to break out of the pandemic psychosis. Now, I think it is thought through boldly. It has taken certain political risks. It is thought through boldly because there is no option with government but to be counter-cyclical. There is just no option about that. So it has kind of ticked all the boxes, but at the same time, I would break it up into 3 buckets. The first one, of course, is the fact which Priyanka alluded to, is the transparency in terms of giving out the figures. I can't help but fall back upon my CAG hat, where we used to protest that things are being under the line, they're going under the line, petroleum bonds, all those kind of things, which were not showing up in the deficit or the revenue deficit of government. But what you asked about disinvestment, you see, the government in January last year, 2020, the finance minister, had said that she requires about 100 trillion rupees for investment in infrastructure. Obviously, tax, non-tax revenues are not going to get you that kind of money. So you had to fall back upon disinvestment. My only worry is on disinvestment that we have had these very ambitious targets earlier on also. And two, which I would draw attention to was, number one was 2015, we talked about disinvestment of the IDBI Bank. Nothing happened. We had to stop talking about it. Then last 3 years, we have been struggling with Air India. Now, this has to happen. And my worry is that the budget has laid down a very good detailed plan, but it has to happen within a time frame, and all the disinvestment revenue, if any has to flow, will be backloaded, because these will take 6 to 8 months time to fall on track. By then you will need to spend. But the good thing is that based on all these, the reforms that the government has resorted to, and to that extent, I think the fact that they have talked about coming back to development financial institutions, they are coming back to the idea of a bad bank, which was hotly debated over a long period of time, but they couldn't get into it. They talked about, now they have been talking about FDI and insurance. So I think this is just the right time for the government to piggyback these reform processes onto whatever is the counter-cyclical measures that we are going to be taking. With the only caveat that I'd like to add, that DFI per se is not a panacea. We've had IFCI, ICICI, IDBI, IIFCL, and IIF, private IDFC also, and the NIP now. The issue is that it will have to operate in a certain manner if these objectives have to be achieved. And the second, similarly, is of the ARC. We have AMCs and ARCs. We have about 28 ARCs in the country. How much have they been able to resolve? So if an ARC is a solution, we need to ensure that this solution works. So for the time being, I'll limit myself to this only, and we move on and we'll get into greater detail about things because it requires the fiscal and the monetary authorities to be working together if both these elements have to coalesce, be coherent, and then move forward. Thank you.
Thank you so much, sir. In fact, I'm glad that you retained that emphasis on the counter-cyclical policy element. You highlighted the importance of the capital receipts in this regard. And on that, if I could now come to Dr. Ajit Ranade. Ajit, we are looking at this budget as probably some kind of a landmark budget because it's coming on the back of COVID. Exceptionally challenging circumstances. India was also going through a period of a fairly prolonged deceleration in economic growth, as we had seen even before the COVID hit. So in a sense, it seems that the budget has tried to do, tick all the right boxes. It's expanded investment in infrastructure in as ambitious, as expansive a fashion it could have done. It's tried to recharge the industrial investor attention on India and even within the economy by taking a large number of measures which should galvanize investments. From an industry perspective, how do you look at the budget? Do you think that this is going to be good enough to actually what we have often referred to in India's context, unleashing the animal spirits of investors, if one can use that phrase. Is it going to be good enough, a recipe for doing that?
Yeah, thanks, Amitendu, and thanks for inviting me to be on this panel. Before the budget was presented in February, we had the quarterly results of companies, listed companies, unlisted companies in September quarter and in December quarter. So we had two sets of quarterly results in the middle of the pandemic. And of course, the lockdown was harsh and severe, as you know, started in March. But by September end, the quarterly results were showing very impressive results on profitability. In fact, growth rates of something like 30 to 35% on profits, not revenues, but profits. So revenues, profits are revenue minus cost. So revenue growth was not as spectacular, but I think there was tremendous amount of cost optimization, cost reduction. And that trend continued in December as well. So already the industrial, or I can say corporate sector, was actually on an upward path. Before, I think the budget, just 1 or 2 days before that, we saw the Purchasing Managers Index, PMI, which is a lead indicator, reach at an all-time high, or certainly a 10-year high of 57.7. That's a lead indicator. We had GST collections reach new highs of 1.15 trillion rupees per month for the month of, I guess, December. And so there was all these indications, the increase in cargo and freight and so on. So that was the backdrop. Already there was some signs that the economy was coming back to pre-pandemic levels, and quite rapidly so. We saw actually a huge impetus, what they call pent-up spending during Diwali season, the months of October, November. That was the backdrop. Now comes the budget. As you said, it was a landmark budget. And I think there are 3 or 4 reasons why we saw such a great response, especially from the stock market, very exuberant, and it's been continuing for 6 or 7 days. Number one was a big relief that there were no new taxes. So there was a lot of talk of a new COVID cess, or a tax on the super rich, or maybe a wealth tax or an inheritance tax or something like that. No new taxes. Secondly, as Mr. Rai also said, I think some other people refer to it, a great sense of transparency and honesty about the budget. A lot of stuff which was hidden in other balance sheets or off-balance sheet items in government companies was brought onto the main budget and the main balance sheet. Second is transparency. Third was, as was said, fearless, ambitious. There was a chapter in the Economic Survey which started with quoting this poem of Rabindranath Tagore, of where the mind is without fear. I don't think the old poet meant it in this sense, but basically the fear of rating agencies, meaning seem to have that bugbear. So reporting a fiscal deficit of 9.5% for this year, present year, and then 6.8 next year. Clearly, there was fearlessness. Of course, it's a pandemic, so of course, it's a very unusual situation. That was the third reason. Number 4 was the P word, privatization word, and that's, I think, what you were referring to. How does the industry look at it? I think very clear and clear articulation, plus some determination which seems to be backed by conviction that the government needs to get out of non-strategic sectors, vacate that space for the private sector. So the finance minister announced privatization of 2 public sector banks, privatization of a general insurance company, increasing the FDI cap, foreign direct investment in insurance, to 74%, then making it easier for sovereign wealth funds, foreign sovereign wealth funds, and pension funds to invest in India's infrastructure or real estate, taking away some sort of prickly tax deduction requirements. So all this is is strong signal for creating a space for the private sector. And these are the 4 reasons, I think. Just let me recount them again. No new taxes, great sense of transparency, fearlessness when it comes to deficits. You can call it a stimulus, but we can debate that. And fourthly, a very big signal that private sector space was being created. And I think that's the reason there is great anticipation. Of course, please remember that back in September 2019, much before the pandemic, the income tax rate for the corporate sector had been reduced to 25% to bring them in line, or 22, I guess, to bring them in line with the ASEAN levels. And for new manufacturing companies, it's down to 15%. And there are a bunch of other measures also, reforms that had been done. So I think there is great anticipation and excitement. This is going to build business confidence, and I hope consumer confidence also will come back. So, consumer confidence and business confidence, they build on each other. When consumers spend, businesses feel encouraged to expand and build new capacity. And when businesses are hiring and there's more recruitment going on, consumers feel better about their job situation or employment situation. So there's more spending. So I think this is what we're going to see. Thank you.
Thank you, Ajit, for being very crisp, compact, and very focused on what you consider are the standalone elements of the budget that make it distinct from the budgets that we get to see across the years. Now, on that, Ajit, you alluded to privatization. You alluded to the question of transparency, no new taxes. Vikram, you have been looking at the Indian budget for decades altogether, and in a sense, you are familiar with the trajectories which Indian budgets have, the shifts they have undergone. And today we have talked a lot about privatization. We have also talked about this kind of, perennial problem which everybody acknowledges, but one is not exactly sure whether it's a question of the can being kicked down the road, like the stressed assets of Indian public sector banks. We do see in this current budget a fairly decisive step in order to address this issue. Mr. Rai alluded to the asset reconstruction company, and there's also the parallel provision of 2 public sector banks to be privatized. From a kind of an outsider yet a close insider perspective that you have, been based in Singapore, you've been following Indian budgets for so many years. How do you sense these declarations in the budget? Over to you, Vikram.
Okay. Thank you, Amit, and thank you for having me on the panel. I will address the issues that you mentioned, but let me just first say just a very broad perspective on the budget as I see it. I think I agree with the previous speakers that it is a very bold and unorthodox budget, but I see it as full of certain risks and gambles. I think the first issue is the gamble on Capex. I mean, you have this headline number of a 34.5% increase in capital spending. I think the problem here for me is, first of all, Capex is a medium-term thing. I think a lot of these, the roads, the textile parks, the production-linked incentive subsidies for 13 industries, all these things will be spread out over like several years. The emphasis is also on the supply side rather than the demand side. So I think there's a little bit of imbalance there. I think the economy after COVID especially needed more short-term demand side boost for job creation. It's still a pretty in the Indian economy. Noted that unemployment is running at more than 9%. So it's surprising that not so much was done about this in the short term. I understand that Capex will create jobs over the medium term. I was a bit surprised that the Manrega allocations were cut this year by about a third from last year's revised calculations. And there's been no allocation for the unorganized sector, which is the same. And I think going forward, the informal sector will need much more attention. I don't know how. Not through big banks, they don't have access to that. Maybe through microcredit, maybe through one-time grants, but some form of social insurance needs to be set up. On the issues that you mentioned, privatization, I agree with Vinod. I mean, this is a game changer here. And as Ajit also said, they've actually used the word privatization. This is for the first time I've heard of Indian finance ministers use that word. Up to now, they've been using the word disinvestment. This is a huge difference semantically. I think that signals that they're willing to cede control. Disinvestment is basically selling assets without ceding control. So they are willing to cede control, at least in two banks, public sector banks, and a general insurance company. So I think this is the clearest signal yet that the government is intent on getting out of business. I think there are some other interesting assets on the block. I think we've talked about LIC, Air India is a bit of a problem child, but I think it's there, and it could be interesting. But there are also other companies, Bharat Earth Movers, there's Container Corporation of India, the Shipping Corporation of India, and so on. So there's some pretty decent assets there. And I think, with the stock markets being buoyant, as Ajit pointed out, I mean, it's an auspicious time to sort of launch this privatization drive. I know it's been, the track record has been pretty bad. I think last year they managed only 15% of what they had targeted, but I hope this year will be better. On the bad bank that you mentioned, I think it's interesting that the government has finally decided to stop relying solely on recapitalization and finally decided to set this up, this bad bank. And other countries that have faced banking crises have done this and done it successfully, including in Asia. You have Malaysia, you had Korea in the Asian crisis, and now you have Europe doing this in the EU. But there are some tricky issues here, and I think actually Vinod would probably be the better person to address these. One is, we don't have a securitization market in India, so maybe there's an opportunity to set it up. But without the securitization market, you can't get off to a flying start. So you have to negotiate with vulture investors on the sale of assets. Valuation of assets is also a problem because a lot of them are illiquid. Then there's this whole minefield of legal issues. Will the bank get clean marketable title, the bad bank? Will it get clean marketable title to the assets? Will the staff face liabilities after disposal of the assets? Can the decisions of the bad bank be appealed? Or will the bad bank be able to short circuit the regular court system? Should it have its own specialized court where the decision can be fast tracked? I think these issues need to be sorted out. So on the DFI, I mean, that's another thing that's a great idea, but we can't leave infrastructure financing to retail commercial banks as we've been doing, and the corporate bond market it can't do it all by itself. So, but operating a DFI, development finance institution, can also be tricky. So we've had, I think Vinod has mentioned, we had these several of them before, either morphed into commercial banks or had to be wound down. So I think one problem, and I spoke to Rajiv Lal, who's a former CEO of IDFC. I spoke to him about this, and he said one problem that they faced was that it was set up as a commercial institution, which had to be listed. And it's very difficult for development finance institution to be commercial, at least at the start. So I think you do need subsidies in the form of government guarantees or other subsidies, and you have to fix a lot of the issues in the in the infrastructure sector. In the power sector, for example, you had these state electricity boards which could not meet the pricing requirements of a profitable power operation. You had problems on the side of the coal supplies. These were unreliable and so on. So I think you need to fix these distortions, you need to iron them out. But maybe there will be projects. There will be projects which have a clear path to profitability, which could interest long-term shareholders, long-term foreign investors, such as pension funds and all that. So despite the past failures, if we get the model right, it has to be a different model from the past. If we get it right, I think it's a great thing, a great way to go. Finally, just to say that I think Singapore is the biggest foreign investor in India. It has been for a while, for several years, and it has invested quite widely in several sectors, from startups to infrastructure to banking and so on. And I think you also in the last budget, by the way, had this tax exemption for sovereign wealth funds for investment in infrastructure. So I think some of the assets that are being planned to be sold could be of great interest to Singapore investors, and Singapore could there.
Thank you, Vikram. I think this again brings us to a particular understanding of the budget, I think, which you summed up very nicely, that it's a path-making budget in the sense of the risks that it has taken, the boldness that it has exhibited. This could be calculated risks. This could be gambles. This could be game-changing in a large number of ways. We will need to wait and watch. But let me now come to a fundamental of the budget, which we till now haven't discussed. And I'm delighted to call on Mr. Shubhamoy Bhattacharya, the next panelist, consulting editor, business standard for this. Shubhamoy, the concept that has been core, repeatedly emphasized in the articulation of the budget, is that of Atmanirbhar Bharat, a self-reliant India. The finance minister repeatedly articulated to this being the guiding spirit, the vision on the basis of which the budget has been based. Now, the way we understand Atmanirbhar Bharat is that there could be multiple interpretations of what this concept actually means. But it would suffice to say that this could be an economic concept, but at the same time, it also has a strong social dimension to it, and needless to say, it has a political dimension to it. The budget is being presented at a time when India's political situation is fluid, like most of the times it is. There are important state elections which are going to come up. There's a certain degree of organized resistance that is getting to be seen coming back on the economic reforms part. The COVID-19 has not really left people in a very happy shape. There are frustrations, there are sort of grumblings. On the whole, from an economic manager, from a government establishment perspective, a challenging political, socio-political situation in which this budget could have been presented. And the Atmanirbhar Bharat was not that much in attention when the last budget was presented. It was a concept that was articulated in the middle of COVID-19, and now we get to see that concept being spelled out very broadly, very ambitiously, very emphatically in the budget that we see. So it would be great if you could just share with us some insights on what do you think are the socio-political underpinnings of this budget in the context of the entire self-reliance narrative. Over to you, Shubhamoy.
Thank you, Amitendra. Thank you for calling me here. And it's always a pleasure to listen to Mr. Vinod Rai. Ajit is always economical with words. Whatever he says, you listen very carefully. And when he says the budget has something to say, then you want to read it even more carefully. Priyanka's commentaries I've been reading through the Oxford Economic Space, and what would we do without the endorsement that came from IMF, Rajan. I think their commentary and their headline, created much bigger headline than probably Nirmala would have got otherwise. I'd like to hear what Manish has to say later on. Vikram, I was listening. I'd just like to draw your attention, and in fact, Amitendra, you put up a very interesting point about the political commentary. First of all, budget, obviously, is always a political document. It has got a lot of economics to it, that is it. But the budget speech, the very reason why finance ministers give a speech is because that's a political document into which they work out to. Even without the speech, you can have the full budget presented, and if it had just been an economic document. The very fact that in India, there is now the farmers' agitation, there are a couple of those agitations, which has obviously become a sort of a marquee agitation, that is not surprising. What is surprising is something that happened before the budget. In January this year, DBS Bank of Singapore picked up controlling stake in Lakshmi Vilas Bank. In the Indian, Vikram talked about privatization. It is an even more leap of faith that a foreign bank has been allowed to pick up a stake in an Indian bank. It wasn't a government-run bank, but the very fact that the RBI could actually think that they could carry through such a step shows that there is a political agenda that is strongly developing, that we shall do what we think is right. And I'm not saying that it's always right or wrong, but the point is that the government seems to be in a position, and that's why I refer to that particular pickup as a very strong signal, because this thing could have easily flared up into a huge political, messy battle game. The very fact that it was able to do it is by RBI was done after a lot of political consultations, which one was aware of. And that is, I think, a very significant piece to add on to the budget story. Which brings me to the budget itself. The interesting thing about this budget is, if one has to read this budget along with the budget of last year, if you read last year's budget and then this year's budget, you find that the direction has not changed. What has changed is the fact which Ajit referred to, Priyanka, they all referred to, is the fact that the government is making clear that where is the money available and where it's not available. So essentially, the same, what I would call the learning curve that has happened between March last year and now is the government has gone through this understanding. And it's been a painful understanding, but the NDA government has been able to realize that unless and until you put your fiscal arithmetic clearly and on the table, then no matter whatever you say through the budget or other announcements through the rest of the year will not be of particular salience and will not be picked up as a significant piece of economic direction, which is what brings in the concept of what you call the Atmanirbhar Bharat. Atmanirbhar Bharat has been around by the Modi government for quite some time through the series of customs duty rises that they've been doing, and the policies of Make in India, the policies of phased manufacturing program. These are all parts of the Atmanirbhar Bharat. The difference again this time that has come along, and again that's a political understanding that has emerged, is that if you're going to do it, then you got to stitch it in with what else you are doing. Remember, this year too, the budget makes a very what I meant to call a very significant point that's again going to raise customs duty on quite a few things. It has also said that about 300 items of customs, there would be a review of the tariff lines. Review doesn't necessarily mean it will go down. They could go up. But the very fact that the markets are not talking about those in a negative format is the fact that the government has been able to stitch together, as I said, a credible story of where it wants to go. So that is, I think, the political learning that has happened in the past 1 year. The very fact that the government, Mr. Modi, the finance minister, holds pre-budget meetings, to which Ajit is privy, and we shall get to hear more about those later on. But the very fact that the prime minister held meetings with fund houses before the budget tells you that where were those directions in the budget coming from. So these things, as I said, have been created and typically by the crisis that COVID created. India works best in a crisis is a very old aphorism, but it has again been proved correct that it has been able to do so. And the big signal change was therefore not in terms of the policies. I'll again say the policies were already in place. It is the fiscal, what I might call putting the money on the table and making it clear where do I want to do, which has been appreciated, and therefore the noises that have been coming. Priyanka has raised a very major point, whether the correction of 2.7% in 1 year is possible, even if we take the revised fiscal deficit target of not 9.6, but something like 8.7 as the fiscal deficit minus the FCI correction. That is a major issue. On that is something that we can look at it later. But one point that I'll ask you to look at is the nature of the disinvestment receipts over the years. If you look at those disinvestment numbers, an interesting thing that you would notice over the last, say, 10 years is that disinvestment receipts wax and wane. For instance, it sort of hovered between 22,000 to average 20,000 between 2009 to 2016. It jumped up to 46,000 in 2017. And in 17-18, it went up to 1,56,000 or so, roughly. If I remember, it was a very interesting figure. And the year after that, it again came down to 84,000 and 50,000, and this year 32,000. What do these numbers mean? It means that the government takes that much number of years to build up public opinion to be able to continue to be able to do one major deal. This took time, and that's why 2017-18, you saw that huge bump up. This year, to the question of whether the government can actually do that thing again, the answer is that there's only one major deal that needs to go through for 1,72,000 to occur, and that is BPCL sale, which is approximately 60,000. The other part is actually very easy. About 1 lakh crore will come from the public issue of LIC. LIC is not being privatized. LIC's shares will be offloaded in the market and will not even be 10% because the Indian market, frankly, can't absorb such a big number, such a big public issue. So it will not even be 10%. I understand SEBI has been asked for permission to make it less than 10%. So essentially, between that and BPCL, we get the entire disinvestment numbers, which is why the government has been able to say that I will not raise any taxes for anything. I'll simply look at these two and get my fiscal numbers onto shore in 21-22. I'll stop at this point. Thank you.
Thank you. Thank you, Shubhamoy. I think, the fact that we are discussing so much about privatization, about disinvestment, about transparency, and I'm so very glad that you brought in you responded to my query on the Atmanirbhar Bharat and the self-reliance narrative. I think what all this means is that there's a certain kind of political legitimacy that has been built up by the government insofar as moving towards a specific economic direction is concerned. Now, that is actually a very interesting juncture at which we can turn to Manish Tripathi. Manish, we have heard an assortment of views. We have obviously not touched upon every aspect of the budget because I remember in one of my earlier involvements when I was with the Indian Ministry of Finance, a very senior Indian ministry official had mentioned that the budget is like an elephant. If you can't see the whole of it together. It's impossible. If you focus on the trunk, you won't be able to see the tail and vice versa. So obviously, we haven't touched on all elements of the budget here, but we have focused on a number of key elements. Now, you are in a situation from where you can connect it to the regional investors' perspective. That is, you are looking at it from an outside vantage point, and there's quite a bit, I would assume, which is there for the investors to munch and chew upon. So, Manish, would be delighted to have your thoughts. Over to you.
Namaskar. Thank you, Amitendu. As you rightly said, I am possibly the Aam Admi here, the common man. So delighted to be a co-host with ISAS. The chamber was very happy to see that this webinar is happening. And as Shubhamoy rightly pointed out in many places, and I think you gave a very good example, every budget has many angles. And the economists' angle, the rating agencies, the banks, the audit companies, the tax planners, investment guys. But there is this SME or micro SME angle, and then a single individual. And I'm sure, this is a very elite panel. And, everything has been said. I was telling you, Amitendu, by the time you'll come to me, mostly everything has been said. But what we want to bring from the chamber's side is the lens or the view, what we did was in the last 1 week, we tried to speak to a few SMEs in Singapore and a few SMEs or businessmen MSME guys in India. And we tried to hear what they wanted to say, and I'll be happy to present that. Firstly, I think Vikramji very rightly said the first thing which people have they had this fear, or everybody was saying, yaar, tax to nahi badh jayega. Because finally, a guy, after all which is said for 3-4 hours, he's just looking at my income tax first, right? So people were very relieved that there was, and you're right, the COVID cess thing was going around on the internet, social media circle. So people were very relieved there is no personal tax which was raised. Secondly, I liked what Vikramji again said, disinvestment versus privatization. So the government is willing to cede control. I mean, we are business people, right? We are not economists. So we always try and buy a company where we get control. Otherwise, they just give us an asset, but keep the control. We do not go there. And the way we think is very similar to where the angel investors, venture capitalists, and then the big boys think. So I think this was a good thing, which the wording was very apt at this time, that privatization is going to happen. Fearless, the word was used. Again, we heard that from the Singapore side, not from the Indian business guys. They said fearless budget because India is not bothered about the rating agencies. I mean, the rating agencies can do what they want, but India is trying to save its nation. They're trying to save people. They're trying to save jobs. So it's 9.5% fiscal deficit, doesn't matter. They're investing more. There'll be a multiplier effect. And I think, Ajitji, you use the word stimulus, can be kind of a stimulus here. So there'll be a multiplier effect. Another word we heard is very interesting, how the common man thinks. They said, oh, Jeff Bezos, after the budget, said 21st century belongs to India. So I think, the worldwide IMF has endorsed it. Many folks don't read that, but that was big news for people. And they started relating that to the budget and the messaging which the Prime Minister and the Finance Minister has given to the world. So this is the angle which came out from the common man. But what we did further, we sieved through the thousands of pages and of course the analysis, and our team came out with 4 places where Singapore businesses can invest in India. I mean, after this budget, there are some packages which feel very amenable for investment, or vice versa. Indian businesses could come here and make ASEAN, now RCEP as the gateway, close to 600 million, a hinterland of market of 600 million people. Now 15 countries, including RCEP, 10 ASEAN and 5 others. So this is the 4, if I may be allowed to read. So infrastructure, utilities, manufacturing, 1 block, which people are saying, I can see this is happening. This is where I can invest. And please keep in mind, I'm speaking on behalf of the 108,000, close to 100,000 plus SME sector which work here. And I think about 8,000 of them are Indian controlled who have very great linkages with India. And the second, they said education, skills, training, and R&D. So people found various patches where they can invest in this after the budget. Technology always. So people found ways that technology will help them. And very interesting, lots of people read about the NRI PIO issues which got sorted out. And I'm going to read that in a minute when I come to that. So if we take one by one, the nuggets which were picked up on were the infrastructure trusts will now be allowed to borrow from FPIs. PFIs out of Singapore can certainly take advantage of this. This was one word which we picked from various SMEs here. Monetization of core assets. So divestments, privatization, people are very happy. They were saying, oh, when the big guys, they will buy an asset in India or a company or a public sector, as an ancillary, I'll get work. So people were thinking there'll be a multiplier effect at the subcontractor level also. $9 billion outlay over 6 years was announced for health systems, the highest so far for the public health management. So people were saying, oh, I think there'll be more on health, COVID-19, prevention versus cure. I have these opportunities. So the health sector in India and in Singapore saw this as a nugget. Another one which we saw is $15 billion has been allocated for railways with a future-ready 2030 National Rail Plan. This would be an opportunity for Singapore companies in rail, metros, carriage manufacturing, technologies. So dedicated freight corridors excited a few people who have been working as contractors in Singapore. 2.5 billion investment on PPP model BTS, bus transport system. So Singapore has, and we have to look at Singapore as one of the most developed and 360 degrees combined public transport system. When I say 360 degrees, it's also about the app where we can know the MRT is on time or not, the bus transport, SMRT, plus the bus itself, electric buses, and so on and so forth. So lots of small SME companies who give support and services, including outdoor advertisement, to this ecosystem. They thought if India is going to go this way, we already have a blueprint, we can invest there. So, and again, I'll step back and say, people view the budget from what they think is the best. I mean, the banks and the economists view from their angle, but the business guys have a very focused view. And this is what we heard. Then education skills and development.
Manish, if you don't mind, if you're able to wrap this up, then we can come to the education.
So the R&D, Singapore being a knowledge economy, the companies here who have IPs, startups, they found that this is a big link, but this budget is going to create a big link between the startups. And the NRIs and PIOs found that the first time there is a one-person company, which enjoys the same legal privileges which bigger guys have. So now they can actually open something called an OPC. So these were the nuggets which the companies found here, and they found that they can create more business between the two countries.
Manish, thank you. I think you really have brought us to that point and that classification of the budget where there are distinct elements which have appealed to investors. It's very heartening to know that, because I think at the end of the day, the interest always lies into what extent the budget has moved out of, the text and the numbers to actually impact the sentiments of investors. So we are going to come back to you on that. Let me now commence the discussion, and let me come to you, Ajit, first, because I'm mindful of the fact that you won't be able to stay with us for the whole length of this conversation. Ajit, there's one thought which I was having in my mind, and I am aware of the positions and the views that you have taken in the context of foreign trade and India's engagement in foreign trade. We have been seeing a lot of emphasis by the government on production-linked incentives. And there's been an effort to expand the scope of production-linked incentives in the current budget with the objective of expanding the capacities of Indian industry to figure most prominently in supply chains. Now, what I wanted to know from you is that how do you look at this overall initiative of production-linked incentives, and do you think that it's really going to take the Indian industry to a situation where the degree of participation in global supply chains is really going to be significantly impacted upon?
Yeah, thanks, Amitendu. Let me just begin by saying how acute the dependence on China is. I mean, so that people have some facts before them. And I'm talking about dependence on intermediate goods, not consumer goods, not mobile phones, let's say. So in electronics, 45% of our imports come from China. In machinery, 32%. Organic chemicals, 38%. In fertilizers, by the way, India is an agricultural country still. 28% of fertilizer comes from China. In automotive parts, 25%. And the most well-known example is pharmaceuticals. India is a leading exporter of bulk drugs to the Western world. And we are proud of the fact that all our pharmaceutical companies are able to gain approvals of the respective regulators, the FDAs of USA and Europe. And the bulk drug exports is a matter of great pride, I think, for the Indian pharmaceutical industry. But the APIs, the pharmaceutical intermediates, 68% of them come from China. 85% of the compressors in air conditioners, 90% of the motors in top-loading washing machines. So that is the kind of import dependency which we, many of those things, this is not high technology. This is not, this is not something which is so unique that it has to be sourced from China. So we have to find a way to incentivize, to climb that ladder of competitiveness and self-reliance, what you said, Atmanirbhar. But we have to be careful that we don't follow the path of being ultra protectionist, in which case it defeats self-defeating because it will be a high-cost venture. So this is the nuance. I call it Atmanirbhar with Atma Vishwas. Atma Vishwas means self-confidence. So we got to have we got to develop domestic capacity, domestic capabilities, but at a benchmark of global competitiveness, so that we actually manufacture some of these things in India, but not only for the domestic market, but also for the global market, including, by the way, China. China today is a $6 to $7 trillion consumer economy and growing. We can't ignore a huge market like that. So Indians have to not only aspire to be globally competitive, but also aspire to export to China. And the fact that Chinese labor force started declining a few years ago already, so that they've reached that plateau and now it's declining. So China is, I'm sure, consciously trying to move away from the earlier 2-decade or 3-decade strategy of low-cost, labor-intensive, export-led growth to now higher value-added, higher, the things like high-tech, artificial intelligence, robotics, and so on. So therefore, they're vacating the space of that which employs relatively low-cost labor, and that's the space that India can occupy. But of course, there's a large domestic market as well. Now, just 2 minutes on the PLI, the production-linked incentives. So it is like saying the government of India is saying, hey, you come here, the more you produce, the more incentives you'll get. But unless you link it to competitiveness, to efficiency, to cost competitiveness, to global competitiveness, it's going to be, you have to be careful that it doesn't end up being, what is it called, gold plating or cost padding. You can't say you produce at whatever cost. For example, in the bad old days, we used to have such schemes in many sectors. So that's the kind of watchword that the PLI scheme started off. The most famous example and now being used everywhere as a showcase is the manufacture of iPhones in India. Apple is the most well-known brand in the world. They are manufacturing iPhones in India. Manufacturing means, of course, there's a value addition. India has become a part of the global value chain. The ingredients, the chips, some of the other thing comes here. There's, I guess, a large amount of assembly work which happens here. But nevertheless, Indians, they're manufacturing in India. But that is a small, they produce probably 2 million phones. I don't know what the global volume is. So it's nowhere as compared to what is manufactured in China even today. But that's a great beginning, and this is going to be extended to electronics, to auto components, and various other. But I just want to say, I want to caution that we have to not let the PLI end up being a cost plus kind of an incentive, so that since it's only based on volumes, it should not ignore the aspect of competitiveness and efficiency. And secondly, unfortunately, the early signs on, I think, the automotive sector, there's a 270-page or some 250-page document which the applicants have to fulfill. Whoever gets selected to be eligible for the PLI so it seems to be somewhat slated against, small companies are not going to be able to meet the huge burdens, the huge sort of compliance burden. So maybe initially large companies, including foreign companies, are likely to have that advantage. But hopefully that will lead to an ecosystem of suppliers, ancillaries, and vendors. I don't think PLI is the magic bullet eventually. It's just a sort of an impetus to give it a kickstart.
Thank you, Ajit. I think that's a really sort of, I would say, accurate, objective, and very specific description of this thing. Thank you so much. And from
we
there,
don't, sorry, just one
Sure.
quick comment with due respect to Mr. Vinod Rai and his early erstwhile alma mater service. We don't, the nightmare is that we don't want now the government to appoint a joint secretary PLI. That's what I meant by the bureaucratic. So I think we have to be careful. There's a balance between self-confidence, self-dependence, but of course, global benchmarks of efficiency and competitiveness.
So what you basically mean, Ajit, is transparency with a hands-off approach. I think that's basically the industry expectation. So I'm sure we will have Mr. Rai coming back and commenting on that at some stage. But before that, Rajan, if I could come to you on a particular point that I think is not just an Indian concern, but also a global reflection. See, we began by talking about counter-cyclical policies. We began by talking about this great need for investment at a time when COVID has ravaged economies. You alluded to the fact that, so many people have slipped below the poverty lines. In fact, developing Asia as such is probably encountering its first recession in the last 60, 65 years. Millions of jobs have been lost. The question, Rajan, that I wanted to check with you on this occasion is that, look, governments are spending and they have kept spending. At some stage, they have to pause. At some stage, even an economy like India needs to, take note of the fact that, look, there's a limit to which expenses can be pushed, because ultimately these expenses would be funded by borrowings. And there's an ability, a certain earmarked capacity of the governments to sustain borrowings. Where do you see this going? I mean, maybe because you look at the region and the rest of the world, maybe if you could bring just a little bit of the comparative in this respect. I mean, how does India look with respect to its peer emerging market economies in this regard? Is it really in a position to sustain the expenditure drive that it has maintained?
Okay. No, I think that's an excellent question and a very important one. So when you're talking about fiscal, there are two issues. One is the fiscal deficit, which is today whether you can meet your requirements, whether there's funds available domestically to borrow or whether you can borrow them overseas. The second issue, which is what you're talking about, is debt sustainability. And there are a number of factors in debt sustainability. First, of course, is the initial level of debt, which in India's case is going to be fairly high, around 80% if you combine the center and the states. And then the other issue is about the disparity between interest rate and growth rate. And finally, the fiscal deficit, or typically what we talk about is the primary balance. So again, the fiscal deficit being at very high rates means the debt levels could potentially be rising. I don't remember exactly, but I think primary deficit should not be more than about 1.2 or 2% for India's case for a debt stabilizing situation. But that, of course, depends on growth and interest rates. And then the issue of growth, whether it will really go back to 6 or 7% growth, which is very critical. If your growth rate goes down, then the benefit you're getting right now on the interest rate versus the growth rate goes down, which creates a fiscal sustainability issue. And this is a challenge across the world. And you'll see that, in fact, we had that in our fiscal monitor when we published in October. The maximum fiscal impetus has come from the developed economies. So the average for the advanced economies was about 10% of GDP. It was lesser for emerging markets, roughly at that time, I remember, only about 4 or 5%. And for low-income economies, the fiscal deficit worsened only by about 1 to 2%. And clearly the reason was that the advanced economies are able, despite having very high levels of debt, they're able to finance those debts because in many countries, their currencies are reserve currencies. In some of the emerging markets, the fiscal there was an impetus, but not as large as the advanced economies. But the low-income economies, which already many of them are saddled with debt issues, debt sustainability issues, they really didn't expand the fiscal as much. It was very little. And you can see in the case of less developed economies, they come back to a lower fiscal deficit. It's only the emerging markets that they don't come back to a fiscal deficit level until 3-4 years. So again, going back to what you were saying, this is a serious challenge. I don't know what the numbers are going to be for India specifically, but to sustain a fiscal deficit of say, you're talking about 9.5% of the federal level, but you have to add in what is called the public sector borrowing requirements. And so to that, if we add the states, which is another 5%, and I would say the public sector, central public sector is another 2% of GDP. So that straight away takes you to, let's say 9.5%, let's say even 4% or 4.5% of the states, 10 and 16% for the public sector. And I'm not talking about the state public sector undertakings, which are really in bad shape in most places. Again, in the central public sector undertakings, you got to be very careful that there are only 5 or 6 companies that sway everything, especially the energy companies. Lots of time the PSUs are making profits because of these oil prices going up. So there is a serious challenge from an overall India perspective, where the fiscal deficit is say 15%, 16%, and even if you lower it over the next few years, and how do you lower it at the state government levels is a challenge, and even for public sector. So there are serious challenges going forward, and one has to be very careful when looking at public sector. Right now, in the short term, from a fiscal deficit perspective, as I said, the flows are there to meet that challenge right now. But going forward is really an issue. I hope I'm clear on that. Thank you.
No, thank you, Rajan. I think that really will be a preoccupying concern for policymakers, and much as we are optimistic about the budget delivering on a large number of fronts, I think at the back of that exercise, there will always be this worry and anxiety over whether certain fundamentals really have been affected in ways in which they can't be mended. Priyanka, I wanted to turn to you on something which I think is fundamental to what we are discussing. We have been talking about GDP growth. Rajan began by alluding to the fact that the IMF looked at an 11.5% number. We seem to have, when we look at the budget calculations, we seem to be having a range of around 15 to 15.5% of nominal GDP growth that we are looking at. The point that I wanted to check with you is that even if we go back in this current financial year, even if we look at COVID and the months that followed, surprisingly, the core rate of inflation has not been very soft. The rate of inflation in India has been kind of, I would say, moderate to high. Now, you've been looking at the inflationary expectations around India. We are looking at a 15% nominal rate of growth. Much will depend upon how the inflationary expectations pan out. What's your sense in this regard? And I particularly allude to this question because government has gone on an expenditure overdrive. There is an effort on part of the government to make people increase consumption. And that in an economy like India has always had an impact on prices. The price consumption, price growth trade-off in India has not really been a very stable trade-off. So what's your outlook for inflation in India?
Yeah, I think that's an excellent question, and not enough focus is there at this point of time in terms of, what could upside risk to inflation materialize in this kind of scenario, because we're so upbeat talking about growth. So in the core case, of course, inflation has come down. We have seen it when I say core case, I mean, what has happened in terms of the headline inflation so far. It's come off from 7.6%. We are already at 4.6%. Can it go much lower from here? My sense is no, it cannot go much lower from here. You've already stated it. Core prices have been pretty sticky. We were in a very sweet spot as far as we were supposed to be in a very sweet spot as far as inflation is concerned last year, with the lockdown. And what we actually saw is that, probably supply bottlenecks and COVID-related disruptions led to an acceleration in prices. So, things like intoxicants, etc., actually had an increase in prices. Also, personal care effects. So there's some sort of ambiguity as to are there these prices so sticky? There does seem to be some sort of pricing power at the end of the corporates. I think it was Dr. Ranade earlier or somebody who was talking about the profit soaring even amongst the pandemic. So we've seen how uh, the price levels have probably contributed to that to some extent. So that being the case, and now we are going through a scenario where growth is recovering faster than expected at this point of time, and we're talking about, we're debating whether this policy stimulus or not, but definitely there are positive externalities that are being created, both in terms of monetary policy still remaining accommodative, if not turning more accommodative, and the fiscal, which we have discussed at length. So I would think that risk to inflation going forward actually, begin to tilt on the upside. Now, why I'm saying risks and not the baseline is simply because the output gap is still negative. So I think it was Dr. Gobil who mentioned right at the start that there's an impact on potential growth. It's just not actual growth which has got impacted. And we did see a wide opening up of the output gap. Even though that's narrowing, it's still negative in this year and for several years actually in our baseline forecast until about 2024 or so. So that kind of puts a lid in terms of how much upside to core prices might come through. But the downside is already limited. And if you look at that there's a positive factor tilted towards growth picking up faster than what we think would happen from here, and the food price base effects reversing as we extend towards March. So we've those are going to go out, and we of course always have unexpected factors to deal with as far as food prices are concerned, especially vegetables. But there's a broader firming up in the food basket. So protein inflation, something that we used to talk about a lot in the past when inflation was around 12%. You can see evidence of that again in the broader food basket. And if jobs are going to come back as economic recovery takes hold, incomes are going to benefit from that. Those kind of inflationary pressures are beginning to be felt stronger than what they were in 2020 definitely. So I would say risks to inflation are to the upside. The baseline at this point is somewhat above 4% to average this year, 4.5%. Not that optimistic that we're actually going back all the way towards the target range. And given that the RBI does seem hesitant to actually respond to inflation, and it's still pretty much focused on growth, real rates will stay negative. So in that kind of an environment, you could see unexpected surprises, negative surprises come up on that front, I would say.
Thank you, Priyanka. I think that is a very, candid admission of the risks that weigh in on the outlook that we have. I'm aware that Manish Tripathi will not be able to be with us for long. Manish, if I could, Manish, are you still there with us? Hi, Manish. Yeah. Thank you so much.
Just about to.
Yeah. I just wanted to have your response to one provision of the budget, Manish. We have been talking about this budget not raising taxes. Taxes haven't been raised, that's true. But there is one tax, and I refer to the equalization levy, India's digital service tax, whose scope has been considerably broadened.
Yes.
Now, this is something which has caused some bit of consternation among certain communities in terms of this beginning to move into or encroach into spaces of practically all online transactions, particularly cross-border online transactions. So from a Singapore investor perspective, do you sense this as a bit of a worry?
I don't think so. I think it's the right move, Amitendu, and keep Alibaba in mind. Keep what happened a month back. The gray area is at what point of time these payment gateways start behaving like a microfinance company. So I think bringing the whole payment gateway, crypto, exchanges, the digitization part of economy into the tax gambit is the right move to do, because I'm sure all of us know RBI has announced that they will also launch a digital currency. China has already announced about 5 months back something called DCEP, digital currency electronic payment. Now, this is akin to a token, but it is only linked to RMB, renminbi. And in fact, we have bank accounts in China, and they've offered us to convert 30% of our assets into digital currency. So more and more, the world economy, it's no turning back, Amit. Everybody will have to move towards digital tokens. We like it or we don't like it. DBS did a great job, got the first digital exchange here. So digitization will become the norm. And the tax laws, we just have no idea. This is right up my alley. This is what we do, right? We are a technology company. In future, the way transactions will happen, turnover taxes on digital currency, the whole gambit has to change. And I think the industry is not in panic. People who do not understand this, they have a panic of the unknown. Otherwise, this is a step in the right way, right move. And finally, the tax laws 10 years from now will look completely different, Amit.
Thank you, Manish. That's actually very reassuring to know that there is a certain degree of objective evaluation of this process instead of suddenly shifting into a panic mode. Thank you so much. Thank you for being with us. Much appreciate your time.
My pleasure. I'm so sorry I'll have to leave, but it was a pleasure.
Thank you. I still have a number of questions to share and engage with this very distinguished panel that we have. Mr. Rai, if I could come back to you on one particular point, and again, this is where I'm kind of going to get into the investor perspective on the budget. Just before the budget, we had this development with the KN Energy, the ruling that came on the KN Energy. There was probably an expectation that there would be a move by the government to go back and take a look at the entire provision on retrospective taxation. Something like that didn't come up in the budget. Do you visualize the government revisiting this subject at any stage? Because this is something which is probably, in a sense, lurking at the back of the minds of potential long-term greenfield investors in India, that whether there will be ramifications coming out of such taxation provisions. What would be your response, sir?
Amitabh, while I must acknowledge that this is, it was much expected that the government would withdraw on this and take a step, but it's got mired into interpolitical kind of a situation. Political in the sense that this was a tax imposed by a previous government. This government withdrawing from it would have given the signal that we are foregoing a certain amount of revenue. Now, that is why, to give it what I would call more of a optical kind of a position, the government had to necessarily take the stand that, okay, we'll go and appeal for it. Otherwise, it could have been politically read as something else, and that would be one more criticism that the government would have to face, that, well, you have foregone this for whatever reason. You are a Burki Sarkar, as I think somebody alluded to it at some point of time. Now, that is probably the problem that we have run into, and that's why the government has been unable to do that. But all other signals emanating from the government clearly indicate to the fact that that kind of a scenario will not obtain in future. So I think that those kind of signals, which have not been publicly announced as yet, have been reassuring, as I would feel.
Thank you so much, Mr. Rai. In fact, that is, I think, an issue which again will remain to to sort of engage the commentators around the Indian budget and the prospects of the Indian economy as we go ahead in future. And on that, Vikram, I wanted to come back to you. We are looking at the budget being a very important document which sends signals, which expresses commitment of the system and establishment to various areas of policy. There is a very interesting measure in the current budget, and that is with respect to the labor market. And this particular provision looks at providing social security to the platform and gig workers. Now, if we just take this narrative back a little bit, we saw that about 4 or 5 months ago, the government passed the labor law reforms. The labor laws have all been structured into codes, and there's a certain degree of classification and organization and rationalization of this. We probably have not given as much attention as necessary to the labor laws that India have passed in recent times, because there's always been this view that Indian labor is very highly protected, in the formal sector. So the hiring and firing is not easy, but there is much little attention paid to the other side of the Indian labor market, which is 85% informal and which is completely unprotected. There's no kind of social security benefit. So when you look at this particular changes that have come in India's labor market, would you describe these changes as something really radical and inclusive at the same time, something which in a sense indicates that the Indian economy in terms of its institutional perspective is really coming of age? It is taking decisions and steps which are mature and which are consistent with what a 21st century economy should do?
Well, I think that's a great question. I'm not sure what the government's definition of a gig worker is, for one thing. I think the important sector to look at here is really the informal sector, the unorganized sector. And I think there, as you mentioned, there are few or no protections. And I think the corporates, the companies, the small MSMEs don't provide any corporate level of protection either. And I think this was most clearly evident during the pandemic, when all these workers were suddenly let go with absolutely nothing. I don't know what kind of social security you can create for these kind of workers. I think it could involve some sort of social security fund that is partly funded by the companies themselves, making contributions, and with also a contribution from the government. But I think these workers need to be stopped from falling between the cracks. As far as the labor changes, as I understand it, a lot of them were in the favor of employers after COVID. They were not really so much in favor of workers. I mean, it in fact relaxed restrictions on firing and so on, probably to improve hiring. So I think I think there's still a long way to go when it comes to providing labor protection, especially for people in the informal sector. On the other hand, I think the formal sector, they have pretty strong protections. I mean, they have the rules are very much in favor of the workers. I mean, there's very strict rules about you can't fire workers without going through courts, all that sort of stuff. But that's of course a very small sector of the economy in terms of employment. So I think there's a huge imbalance between the protections in the formal sector and the protections in the informal sector, and that needs to change.
Thank you, Vikram. That is, I think, a point which is not much appreciated, at least in the context of the Indian economy. And I think this is something on which there's a lot of work that has been done in the past. I mean, it's been a work in progress in the pipeline, but it has finally come to fruition. So I think we are probably, in a sense, getting to see the Indian labor market losing a certain degree of the undesirable heterogeneity that it had in its regard. The difference between the formal and the informal was too stark. So probably that's sort of getting off and away in some respect. Shubhamay, I wanted to come back to you on another aspect of, the economic reforms, which have really been given a kind of a concerted push in this current budget. I remember there's been this conversation among Indian economic commentators a lot of time about monetization of assets that are held, by the government, particularly the brownfield investments, which have already been done. There's a lot of land, for example, that is held by the state government and public sector enterprises. Now, those are assets, but they're idle. And so from a business manager's perspective, not necessarily as an economist's perspective, but from a business manager's perspective, a rational decision is to monetize these assets. And when one does that, one clearly opens up a completely new avenue of revenue mobilization for the government, and also for putting fresh blood into the running of these enterprises. A very radical announcement, but how do you see this happening? What do you think will be the route ahead for India in this regard?
Yeah, that's actually, Amitendra, that's point. And let me say this way, that of all the budget announcements, this one seems one which I would say for the financial sector, probably the one which is already in place and therefore can go places. To put it simply, what has been happening when the government has been saying that private sector should get into projects, government-run projects, it is like something saying veg ko non-veg khilana wala type ka cheez. To put it on that way, that it's asking them to do something which they don't want to do. So what's the way out? The way out is for the government to build projects and then sell them to others. Is it difficult? No, it's not, because the government used to do it earlier. And today, when we see the most successful examples of privatization, we see projects which have already been built. So airports get attractive bids, ports get attractive bids, railways have got attractive bids. Why? Because those projects have already been built, completed, and are ready to be generating cash the moment the private sector walks in. That InvIT model, therefore, has become successful and has already generated about 80,000 crore of money for the government, simply because it is selling out projects which are already there in the market. The moment government says that I ask you, Mr. Private Sector, to build a project, get land clearance, get assorted other environment, other clearances, it just doesn't work. The TOT in roads has worked. This is the toll operate transfer projects. And the reason why Macquarie and others have, so many others have bought into those, is simply, again, because of the same thing as you pointed out rightly. These are projects which are already built. So the way for the government is, therefore, to build projects, use them on EPC basis. The government can also raise funds. And that's the reason why some of the commentaries have been appreciative, saying that yes, that's the way to go about it. You cannot have a greenfield investment happening in India on a PPP mode or any other mode, simply because it doesn't work. The success rate in those are very low. The metro projects, remember, are an exception, because metro projects come with every other clearances packaged. But no other projects, like the coal mines, come with environment and other clearances cleared up. So that is why these projects work well. And that is why you find that the investment sector, Manish was talking about those, that these are the projects which they therefore would like to bid and build. It is not something, if today somebody had said that you would set up a railway line in India on a PPP mode, that is asking for a very big, major investment challenge, which is not possible given the series of clearances that's required. And that's going to be there in India for a long time because of the lots of things. You cannot, certain projects, certain approvals cannot be fast-tracked. So there will be delays, and delays would mean by rising up of interest cost. So obviously, that's absolutely correct. May I just point out one thing which Rajan was talking about on the expenditure thing?
Yeah, sure. Go ahead.
Rajan, you talked about expenditure rising, but if I look at the budget projections for next year, 21-22, I find that it's actually just a rise of 1% over 19-20. So essentially, it means that the government is actually its expenditure. There's actually a squeeze on revenue expenditure in the coming year, because a rise in the Capex. Despite that, the share of the total government expenditure in GDP will decline from 18% to about 16% the next year. And given that, that will mean about just 1% increase in government's total spend. It's only in this year that there's been a record 28% increase in the current year, and that is basically because of lots of factors. They were cleaning up, I mean, not just FCI, but also the fact that the government has put in money into the economy. But next year, the revenue expenditure actually gets squeezed. And that's, I would say that actually is a challenge. Because when you're squeezing revenue expenditure so hard to come to fiscal deficit considerations, which Priyanka was pointing out, that could be somewhat countercyclical. Government's expenditure in almost every sector, somebody, I think Vikram pointed out about NREG being low, and that's true. Every other investment projects have been kept very minimally funded. I suppose it has got to do with the fact that they are also projecting a very low tax rate of revenue buoyancy. It's about 1.16, which is very low. So altogether, that's where I stand. I just wanted to say thank you.
Yeah, sorry, I don't think I talked about revenue and expenditure separately. All I was saying, the fiscal deficit from a country perspective is very high as the debt level, and therefore it's going to be challenging over the medium term how the fiscal remains sustainable. Yeah. Sorry, thanks.
No,
sorry.
that's perfectly fine. I think that's an excellent clarification that we needed. Mr. Rai, are you still with us online on the program? There's something I wanted to check with you on.
Yes.
We are reaching the end of our fascinating conversation today, but I wanted to come to you on a subject which we probably just can't avoid discussing. I mean, this whole issue about the farm laws in India and this great degree of protest, the amazing amount of visibility for the right reasons or the wrong reasons that it has acquired in the international media. What I wanted to check from you, sir, is that do you think in any way the protest on the farm laws did influence the budget, or more specifically, does this protest symbolize some sort of an inspiration for other stakeholders to act against reforms that this budget has proposed? Might it mean that we are going to see a greater contamination in the atmosphere surrounding reforms in the days to come?
I think one thing that certainly has happened is that if government had in mind some more far-reaching decisions or reforms that they had in mind, they have held their hand back. Because they would certainly like to take care of one, get it out of the way, and then move on. And one issue which I think has come to their notice is that irrespective of the dialogue which has taken place on this particular issue in the last maybe a decade or a decade and a half, it was essential for them to have taken people along before they went in for this kind of a reform process, which came suddenly in the form of an ordinance and covered a large cross-section of the society, of the population. And obviously anything within the country, farmers and Kisan one side and Jawan on the other side, they have a certain relevance in society. So, government does not want to be taking on more than they can chew and settle for the time being. So to that extent, whatever they have had in mind, they have held themselves back. Things like labor moved better because it was more from the states that it had come to them. Certain states had already adopted those reforms, whereas this was far more far-reaching, consequential in that sense, and obviously the opposition had built up very severely only because they introduced it during the pandemic and as an ordinance.
Thank you so much, sir. In fact, now that we have just a few minutes left to conclude, what I would like to do is I would like to have all of you responding to one particular question that I had on my mind. You know, we have been looking at the capacity of the Indian economy to rebound from the unprecedented contraction that it has experienced. And statistically speaking, or otherwise speaking, the next financial year that we are going to move into is expected to be a year of rebound, at least coming out of the low baseline. But I think the question that is uppermost on the minds of most analysts is that whether that rebound will be a one-off occasion or whether will India be actually able to go back to a high-level growth path, something which was the Indian economy has been accustomed with. And the Indian economy has traditionally been identified with over the last 10 to 12 years with around a 7% plus growth trajectory. So do you think that the budget has done enough to bring back the Indian economy to a 7% plus GDP growth path in the medium term? On that, I'd like to have all of your opinions. Let me start with you, Priyanka. Do you think the budget has done enough in this regard?
I don't think a single budget can do that, simply because the scaring of COVID was so sharp, and the money in some sense did not come through at the time it was needed. In some sense, it's a belated response. It was also mentioned at some point of time on this very panel that I think it was Mr. Khanna who said that it is more of a supply side response and not a demand side response. Now, you could say from a near-term perspective, that does matter. Although, as you move out towards the medium term, the supply side becomes much more important. But we don't know that how that slow consolidation of 4.5%, how is it going to materialize? Because 2.5% of GDP worth of capital expenditure, we have to yet to see that the government can actually effectively do that. And to do it year after year, I think it's an unrealistic expectation. That number has to normalize back towards, 1.7% of GDP or so. So to give you a short response, because there is no short response, but there's a time constraint, I would say what it does is that, we have spoken at length in terms of, it creating a more favorable environment for private investment in general. And if the execution does happen as it's anticipated to happen, then we could see, on the margin investment picking up, not getting hurt as much as we were earlier anticipating. So just to give some figures out there, I personally downgraded India's medium-term average growth forecast from 6.5% to 4.5%. Before the budget. After the budget, I've nudged it up by a couple of percentage points. So that's what the budget does. There's a labor market scarring, which is much more difficult for the government to handle via budgets because of the large informal sector employment, which has got hurt. And even as that comes back, the income levels on those front are not going to come back to pre-pandemic levels anytime soon. We've already discussed inequality and the social impact on things like that. So from a supply side perspective, it's going to be pretty challenging to go back to where the pre-COVID baseline was, let's say for 2025, in terms of every factor: labor, capital accumulation, productivity. The budget helps at the margin, but one budget does not change that. India still has a sizable medium-term scarring, I would say.
Thank you, Priyanka. That's wonderful to hear. Rajan, are we going to see India return to the 7% plus growth trajectory in the medium term? Has the budget done enough in that regard? What are your thoughts?
I think I agree with Priyanka. Sorry.
This is not demanding an astrological prediction. This is just an economist's view.
So from an economist perspective, I would say that as Priyanka says, one budget does not necessarily change the structure. And I think there was a structural problem with the economy before COVID. Growth rates had slowed down sharply, and so had the investment rate. And if you were looking at 5%, even before COVID, people were debating whether India's potential GDP growth rate is 7% anymore. And I think we have to go back and look at that before we can really talk about going back to 7%. I think 7% over the medium term is something we all want, but I think it's a long shot right now, given the scarring and other factors.
Thank you, Rajan. Vikram, as both Priyanka and Rajan say, one swallow doesn't make a summer. So this one budget, historic budget, far-reaching budget, game-changing budget, you alluded to the risks and gambles it has taken, you alluded to its bold character. Is it going to serve the medium-term objective of getting India back to 7% GDP growth?
Thanks, Amit. I'm not sure it's even going to be a bounce back to the extent that has been forecast in the short term. I mean, I have an issue with the lack of demand, and that is not being addressed. I mean, this is the medium-term budget. This is a supply-side budget. That's number one. That's my number one concern. Number two concern is the possibility of fiscal slippage, which Priyanka and others have referred to. I think very few people believe the 6.8% number for even next year. I suspect that the credit rating agencies will cut India some slack. First of all, because a lot of fiscal deficits have blown out everywhere, and ratings are a relative exercise. And second, because India has been more transparent with the budget. So hopefully that will happen. If they do downgrade India, I think there will be problems for the private sector. That's number two. Number three, I'm concerned about the cutting of budgets for education I mentioned, which is, I think, critical for any sort of sustained growth in the future over the medium term. I think you had children being out of school for 6 months. I think research has shown that this leads to a lot of scarring. Children forget, not only don't learn more, but they forget what they already learned. I think there should have been a sort of a jump in the budget for education. And I think we are far behind the 6% of GDP target that we really need to be for education if we are to have sustained growth over the long term. So I think these are really the critical supply side issues that have not been addressed. They're addressing issues like infrastructure, which is great. But I think the whole social sector, the supply side and social sector issues are not being addressed. And I think that will hold back India from sustained growth over the medium term.
Thank you, Vikram. Shumoy, we are running out of time. So very brief, very upfront response from you as you normally provide. Has the budget done enough to take India back to where it should ideally be, 7% plus?
I think the budget has done whatever. What the commentators have all missed out is asking the states to be responsible. The Finance Commission award that has just come through has said over the last 10 years, every state has slacked off on raising own tax revenue and even non-tax revenue, which they have within their powers, not by asking for extradition of it. The data is very clear. And I think the commentary, which is about social sector expenditure, health, and education are both state responsibilities. States are not doing enough. 2/3 of health expenditure is supposed to be by states. States are not funding it, overfunding it. Similarly, on education, states are not funding it. I don't know what can happen by raising money for education when school students are dropping out. The point is to ensure school students stay in schools. And states are not ensuring that the state teachers and others, that ecosystem happens. I think that is where the problem is on the social sector. That's where I'll send off. Thank you.
Yeah, thank you. Thank you so much. Lovely insights. So, sir, like I always do, let me come to you for the last word. Do you think this is a budget which is really going to, bring India back to that level where it was at a point in time, but from where it somehow seems to have dropped down a fair bit, even before COVID and thereafter. So do you think this budget is going to serve the purpose? 7% plus GDP growth?
Amitendu, let me agree with the previous panelists in saying that there's too much of hype, too much of reliance, and too much of expectation from one budget. One budget may not be in a position to do it, but where I'm going to take a contrarian stand is that considering the way the economy has over the last 4 to 5 months responded, and considering the fact that the government has been able to provide incentives in those sectors where the response has been, I see that, well, I won't say 7% itself, but towards the end of FY22, we will be hitting that neighborhood of that 7%. And I'm pretty upbeat about it because, all we need to do is to ensure that services sector kicks in. That's about 54% of the GDP that it provides. All we need to ensure is that agriculture gets back to it. We have a good monsoon, and that the unorganized sector, which in terms of employment providing, the MSME sector, to which this budget has not given so much of resources, but which was built on the stimulus package, which had been given with, was the third stimulus package, third if I remember correctly, which provided a huge amount towards MSME sector. If that can kick up, I am quite positive that we will be able to reach that target of 7% that you are alluding to.
Thank you so much, sir. And I think, as I always believe, that economic commentators are really economic about time. And we have done a fantastic job today. We are only 85 seconds beyond our allotted time, despite having started a little late. I'll just conclude by saying that we had a engaging, engrossing discussion, and all that it points to is that this budget is quite an unusual budget. It's a different budget, not just because of the context that it had, but also because of the announcements that it has made in terms of its organization. We forgot to mention that stylistically it was a paperless budget, the first of its kind. And also the fact that there are certain perspective changes that have been brought into the budget in terms of transparency, in terms of its reporting. I think the general consensus is that the budget has tried to do as good a job as possible. But having said that, whether it is enough, whether it really has been able to put the Indian economy back onto a path of consolidation, recovery, and sustenance is something that will be revealed over the months that are awaiting us, insofar as the budget being able to fulfill its very ambitious targets. I'd like to really thank all of you, the distinguished panelists, on behalf of the Institute of South Asian Studies at NUS and the Singapore India Chamber of Commerce and Industry. Let me thank all the participants who have joined us today. We had a very large, very robust participation. We went live on the Facebook. This event was live streamed, as our events are, and we have really had a very extensive turnout. I'd like to specifically thank my colleagues from ISAS, Ramita Ramachandran Iyer, Jordan Ang, Yusuf Muhammad, for putting together this program, and also Pooja and Radhika from the SICCI for making this program a success. Thanks to you all. Do come back to us again for our future events, and wish you all a very good evening, those who have joined us from Singapore, and wish you all a very good afternoon to those of you who have joined us from India. Thank you so much.
Thank you very much. And Amitendu, special thanks to you for having conducted it so well and making us stick to our time. Thank you so much.
You're welcome, sir. Thank you so much.
Thank you.
Thank you, Amitendu. Yeah. Thanks,
Thank
everybody.
you.
Yeah.
Thank you.
Bye.
Bye-bye.